All right, so today we are diving into a topic that I think a lot of people have been talking about lately, money.
Yeah.
You sent this paper over. Fiat currency is a problem, free banking as a solution,
hmm
and wow, it's a bold statement right off the bat.
It is. And they really come out swinging,
Yeah,
taking aim at the heart of how our modern financial system works, or some might say doesn't work.
and they're saying that ditching gold-backed money for this fiat currency, the stuff we all use every day, has had some real consequences.
Yeah, and I think that's the core of it.
Yeah,
Fiat currency, it's all built on trust.
right.
Trust in the government that issues it. And for some, that trust, well, it might feel about as stable as a house of cards.
Especially with what we've seen with prices lately.
Yeah.
Come on, groceries are getting out of control.
Right.
It feels like this paper's argument that fiat currency leads to inflation
Yeah.
is hitting a little too close to home these days.
Yeah. It's a sneaky thing, inflation. It's like the silent thief in the night, slowly but surely chipping away at what your money can actually buy. Think about it. $100 10 years ago versus $100 today. Two totally different ballgames.
Oh, absolutely. And you don't really see it happening. It's not like this big event.
Right.
It just is constantly eroding away at your purchasing power.
Exactly.
Okay, so something that really blew my mind in this paper, it points out that so much of our money, it's not even created by the government. It's actually commercial banks, just like making new money every time they issue a loan. What?
It's one of those things, it's kind of a head scratcher at first, but essentially banks aren't just lending out money that's sitting in a vault somewhere. They're actually creating new money in the economy through the act of lending itself.
So it's like this weird circular thing. They create money by lending it, but then that money is used to pay back the loan.
Yeah, it's a system built on a lot of moving parts, that's for sure.
Okay, so the paper goes on. It's like, we're just getting started. They make this whole case against the government controlling money. And then they're like, hey, we've got a better idea. Free banking. Now, full disclosure, when I first heard that, I thought it meant like free ATMs for life.
Huh. I think we've all been there.
Right. But obviously a little more complicated than that. So break it down for us. What is free banking really all about?
It's more about freedom from control, in a way. The paper is advocating for a system where the government takes a back seat. They say, just let banks compete, let the market do its thing, and that's what will create stability.
So less like one big referee calling all the shots, more like a decentralized free-for-all.
Exactly. They even use the example of Scotland's banking system way back in the 19th century. Banks had a lot more autonomy back then, and you know what? They argue it worked.
Interesting. But that feels like such a radical shift from how we think about money today.
Yeah, it definitely challenges a lot of the assumptions baked into our current financial systems.
So it sounds like they're going for like a total system overhaul here.
It's a pretty bold vision, for sure. But at the heart of it is this idea, money, it should be a tool for good.
Okay, I like the sound of that.
Right. Not something that just ends up benefiting one group over another.
So like taking the power out of the hands of the few and giving it back to the people.
They bring up this concept of a veil of ignorance.
Now, before you go all philosophy professor on me,
Oh, no, I hear you.
what does that even mean in the context of money?
Essentially, imagine if no one knew their place in society, rich, poor, middle class, it wouldn't matter. How would they design systems to be fair?
Okay, interesting thought experiment. So then apply that to money. Are they suggesting that just because someone has a lot of it, it shouldn't give them more power or influence? Because let's be honest, right now, it kind of does.
It does, and that's where this paper gets really intriguing. They argue that when you have a central authority controlling the money supply, well, it's just too easy for that power to be misused.
Yeah, throughout history, we've seen how that story goes. Governments printing money to fund wars or propping up their pet projects.
Exactly. And who suffers? Often it's the everyday people who get hit the hardest. Their savings lose value, their purchasing power shrinks.
So their argument is that by decentralizing things, taking the power away from that central authority, we might actually create a fairer system.
It's a compelling argument, for sure, and one that has sparked some really heated debates throughout history.
It's a lot to unpack, but it sounds like this paper is urging us to take a hard look at the systems we've created and ask ourselves, are they really serving us? Or is it time for a major rethink?
And you know where this whole debate gets really interesting? The paper dives into this historical economic showdown, like a rap battle of the minds. The banking school versus the currency school.
Oh, I love a good economics throwdown. So who were these factions and what were they arguing about?
At the heart of it, it was about the power of banks to create money, specifically through lending. The banking school, they were all about letting banks expand credit.
So they were cool with banks basically conjuring up new money out of thin air. That seems a little, I don't know, risky.
Well, their argument was that as long as banks were lending responsibly, backing those loans with real assets, actual productive investments, it wouldn't lead to runaway inflation.
So they were all about that self-regulating system.
Exactly. They believed that the market would keep things in check.
But, like, didn't everyone buy into this whole trust the banks approach?
Not quite. That's where the currency school comes in. They were a lot more cautious about expanding credit. They wanted to tie the money supply to something tangible, something real, like gold.
Ah, the gold standard. So the currency school was team gold all the way.
They weren't afraid of a little bling. Their argument was that too much lending, even with the best intentions, could throw the whole system out of whack.
Too much of a good thing can sometimes be a bad thing, right?
Exactly. They argued that this excessive lending could distort the natural interest rate, leading to those boom and bust cycles that, well, we've seen how those can go.
Oh yeah, those economic bubbles that always seem to burst and leave a mess everywhere.
And what's fascinating is that the paper highlights how this debate wasn't just some theoretical squabble.
Right.
It was about power, who gets to control the money supply, and ultimately influence the entire economy.
Because whoever controls the money controls everything, right? I mean, it impacts interest rates, lending, government spending, even the distribution of wealth.
And that's why those historical examples of currency devaluation are so concerning.
Right, because if a government can just print more money whenever they want, doesn't that just undermine the whole system?
It's like trying to bake a cake and just deciding to double the sugar every time you're running behind schedule. Might seem like a quick fix in the moment, but...
Disaster in the oven.
Exactly. And the paper argues that fiat currency, by its very nature, can create this temptation for governments to overspend and inflate their way out of problems.
Okay, it's kind of like that easy money policy can have some pretty nasty side effects down the road.
And they really see this free banking system, with its emphasis on competition and limited government intervention, as a more sustainable path.
But isn't there a risk that it could become a free-for-all? Like every bank can just issue its own currency. Wouldn't that be incredibly confusing? Imagine trying to pay for groceries with like a fistful of different banknotes.
It's a common concern, but the paper argues that in a truly free banking system, banks would be incentivized to maintain the value of their currencies.
Because their survival would depend on it.
Exactly. It's like a built-in quality control. If people start losing faith in a bank's currency, they'll just take their business elsewhere.
So the market itself would punish banks that get too big for their britches.
Exactly. And they talk about this law of reflux. Basically, if a bank issues way more money than people actually need or want, it could lead to inflation, right?
Right. So too much of a good thing can actually devalue it.
Exactly. And as prices rise, people might start losing faith in that bank's currency and choose to do business with banks that have been more responsible. This overissued money would eventually flow back to the bank that printed it, kind of like a boomerang.
So it's like a self-correcting mechanism.
In theory, yes. Now, they acknowledge that even systems without a central bank aren't foolproof, but they make a compelling case that free banking could, at least in theory, lead to greater stability.
It's a bold claim, for sure, but it makes you think about all those fundamental assumptions about how money works. Like, are the systems we've created actually serving us well? Or is it time to start thinking outside the box?
Okay, so we've talked about the potential downsides of fiat currency. We've gone deep on this radical idea of free banking. But this paper doesn't just critique the system. It's like they're offering up a whole new playbook.
And they go all in on the Austrian School of Economics, which really throws down the gauntlet, challenges the very foundation of how we think about money. They're not messing around. It's like they said, hold my beer. We're about to rethink the entire concept of money. So what's the Austrian school's big idea? And how does it tie into all of this?
Well, the paper really highlights the work of Karl Menger, a big name in Austrian economics. Menger, he wasn't buying those traditional explanations of money, like governments just decreeing something as valuable.
It always felt a bit like, poof, this is money now because we said so.
Right. But Menger saw it differently. He believed money emerged naturally, organically. People, through trial and error, gravitated towards things that worked best for exchange.
So it's like out of the chaos of barter, money emerged as a solution.
Exactly. Imagine a world without money, just pure barter. You need a new axe head, but the blacksmith only wants firewood and the woodcutter's all stocked up on axe heads. It'd be a nightmare.
Talk about a logistical nightmare. I can't even imagine trying to pay my rent in chickens and potatoes.
Right. So Menger argued that certain goods naturally rise to the top as money because they're, well, good at being money.
They've got that dinerability, as the paper calls it. It's not about being shiny or rare. It's about how well something actually functions as money in the real world.
Exactly. And that's key to the Austrian school's argument. Sound money emerges from the free market, from individual choices, not from some government mandate.
Which brings us right back to free banking. If you believe the best form of money will naturally emerge through competition, then it makes sense to advocate for a banking system that reflects that.
Exactly. Let banks issue their own currencies. Let the market decide what works. They believe that's how we discover the most dinerable forms of money, the ones people actually want to use.
But they're not suggesting we all start hoarding bottle caps and trading Pokemon cards, right? There's still an emphasis on the core principles of sound money, scarcity, stability, things that prevent a currency from becoming worthless overnight.
Absolutely. And this is where it gets really interesting. The paper points out that while the Austrian school is often associated with a gold standard, their theories don't necessarily require it. They're open to other forms of money as long as they meet those fundamental criteria.
Okay, so then the big question, Bitcoin. It feels like the paper is saying maybe, just maybe, Bitcoin and cryptocurrencies in general could actually embody some of these Austrian school principles.
It's true, the potential is there. Bitcoin is designed to be scarce. There's a limited supply, just like gold. It's easily divisible, easily transferred, and it operates on a decentralized network, no central authority controlling it. These are all characteristics that align with the Austrian school's vision of sound money.
It's like Bitcoin is the unexpected love child of centuries of economic thought. Who knew a digital currency dreamed up by, well, whoever created Bitcoin could breathe new life into these old-school economic theories?
It's definitely a fascinating development, and the paper dives headfirst into this new frontier. While they don't claim to have all the answers, they suggest that digital assets like Bitcoin could represent a massive shift in how we think about money and banking.
It's like we're on the verge of a monetary revolution, and this paper is our roadmap. So what's the takeaway for our listeners? What do we do with all of this?
It's a call to action. Rethink your assumptions, challenge the status quo, and engage in these conversations about the future of money. Whether we end up with a free banking utopia, a Bitcoin-powered economy, or something we haven't even imagined yet, one thing's for sure. It's going to be a wild ride.
And on that note, I think we're going to wrap up this deep dive. My brain is definitely full. If you're feeling the same way, don't worry, that's a good thing. It means you're thinking critically, asking questions, and who knows, maybe you'll be the one to invent the next Bitcoin. Until next time, keep exploring and happy trails.